Good afternoon, everyone. Thank you for joining us for what I think will probably be the easiest topic you deal with today, the Paycheck Protection Program forgiveness deal. We're going to try to make this as simple as we can for you. It's always interesting when you get a two-page form with 11 pages of instructions on how to complete it. It's not obvious to an awful lot of people, and there's a lot of nuances. We'll do our very best to explain those today. Walk through kind of the basics of the program, uses of funds, forgiveness math, kind of some best practices that we're encouraging everyone to take on. And then we've got about 24 questions at the end that we'll walk through that hopefully will answer as many kind of the nuances as people can think of. And of course, at the end, if you've got other questions that are going to be of interest to anyone, please feel free to chat those and we will take those on at the end. So my name is John Schweisberger. I'm a partner in the business outsourcing services practice at Armanino and responsible for our SBA loan programs within Armanino. I'm joined today by Dave Roberts. I think many of you know Dave. Heads up our law firm services practice and has been a frequent guest of the BHBA. And so together we will do our best to make this program as clear as possible for all of you today.
Thanks, John. And just one thing, I don't know that you mentioned the prerequisites for this webinar is a glass of wine and potentially a Valium.
I might put him to sleep all by myself.
When we get into the details and the math, it does get pretty hairy. So here we go. Buckle in.
All right, we'll do our best to get you taken through it. I'm assuming by virtue of you being here that you probably all got a PPP loan or know someone who did. So hopefully this can be of value to you. So let's talk about forgiveness, shall we? Let's go through kind of the basics. I think most people know most of these things, so I won't dwell on these, but we will get into the details as we go a little bit further down the road. So your forgivable amount is a function of the amount that you spend on qualifying payroll costs and 3 categories of operating expenses. Over the 8 weeks, that begins the date that you were funded by your lender. With, of course, an interesting exception, because the government loves to put exceptions in and options in just to make it harder to figure this stuff out. And we'll walk through all of those. There are 2 reduction factors that can bring your forgiveness down, and this is a critical thing for people to understand. One based on FTEs against a baseline period, the other based on salary and wage reductions at an employee level past a certain threshold. And again, we'll walk through all of the details on that. Anything that is not spent rolls over into a 2-year 1% note. No payments required until basically 3 to 4 months after you finish your covered period. And a couple of key points that if you take nothing else away and you decide I've had all I need of this webinar here 5 minutes in, take these bottom 2 points with you. 1, make sure that what you do from a spending standpoint is provable and that it's related to the funds you received. And 2, make sure that you develop a strategy now and during the process for how you spend the money so that you can make sure that you're aware of what your forgiveness potential is, not be surprised, in essence, be a planful and educated borrower in this case. So let's walk through the basics, unless Dave, you got something you want to add to
Yeah,
that?
John, just as a kind of statistical point, we surveyed about 200 law firms in California. 93% of them applied and received PPP loans. So really heavy in this vertical. So just wanted to throw that out. There's many, and out of that, I believe only 3 of them that I am aware of have returned their funds within the safe harbor. And I'm sure you'll be talking about the safe harbor.
I will be talking about the safe harbor, but not the return of funds, because that date sailed yesterday.
Correct.
Okay, so let's talk about a couple of pages on use of funds. Pretty straightforward. he said. Payroll costs, which are a function of up to $100,000 on an annualized basis, or for our purposes in 8 weeks, $15,385 of salaries and wages, bonuses, commissions, tips, etc. Add on to that the employer portion of the health care benefits, the retirement benefits, and any state and local taxes that you may need to pay for your employees. Those are not capped by that $100,000 number, nor is it capped or prorated for a $100,000 plus individual. So you may have a $200,000 a year person, which would be $30,700 or so dollars for the 8 weeks. Only $15,385 of that salary is available for forgiveness, but all of the healthcare benefits, retirement benefits that you may have paid to that individual will be allowable, subject to a couple of details we'll talk about a little later on. In addition, there's actually 4 other categories of expenses that are allowable use of PPP funds. That's payment of interest on a covered mortgage for both real and tangible personal property, which is a little bit different than what a lot of people thought was just on real property. So if you may have taken out a principal and interest loan to buy something else, it will apply, at least the interest side of that will apply in this as a allowable use of funds. In addition, any real or personal property that you're leasing, that rent is covered as an allowable use of funds, as well as utility payments, which are the usuals of water, electric, gas, internet access, telephone, and transportation, which we haven't seen a real clear definition, but near as we can tell, that relates primarily to gasoline for company-owned vehicles. Not sure how much that will be relevant with this group. There's also, as I said, a 4th expense category beyond payroll that's allowable use of funds, and that is interest on any pre-existing non-mortgage debt obligations. But buyer beware, that is not a forgivable expense. You can use the money for it. It just comes off the top on your forgiveness calculation. Whether that was by design or not, it has yet to be corrected, but it's very clearly allowable in Section 1102 of the Act, and very clearly excluded, not deliberately perhaps, but it's not included anyway in the Section 1106 that hits the forgiveness. So beware of that little jewel. And on all of these things, the contracts needed to be in place prior to February 15th.
Hey, John, maybe you can make it a little more clearable under the rent and lease agreement. Does that include copiers?
Is that personal property? I would say yes.
Thank you.
And again, there's an awful lot of people who thought this was just for, basically your office rent, but it's real or personal property. So with that as a backdrop, let's jump into the fun of forgiveness math. And it'd be great if I just had like a chalkboard or something, but we're just going to have to go through a lot of words here on the page, and I apologize for the eye chart, but every word in this stuff actually matters. So everyone's aware of the 75% rule. What we now have clarity on as of last Friday night is that is 75% of the loan amount spent needs to be used for payroll cost or more. But that's the intended target. It also applies to the loan proceeds. So what does that mean? That means that if you got, say, $1 million loan and spent 800,000 of it, 600,000 of the 800 needs to be spent on payroll, and 750 of the million, once you finish spending that after your covered period, also needs to be spent on payroll, with no allowances given yet on exactly how we're supposed to certify that or confirm that or who audits that. They left that part out, but nonetheless, that 75% rule applies to both the 8-week spent amount and the 2-year loan amount. Okay. Therefore, conversely, up to 25% can be used for non-payroll costs. As I mentioned earlier, there's 2 reduction factors. This is where it gets very, very interesting, and they go in this order. First is a reduction in salary or wages greater than 25% during the covered period as compared to Q1 of 2020. Fortunately, last Friday night in their guidance, they did insert the word average into this reduction calculation. Originally, it was total compensation. So let's compare the total compensation in 8 weeks against the total compensation in 13 weeks. Well, here's a surprise. That's less than 75%. So fortunately, that got resolved, and it is now the average during the 8 weeks against the average during the first quarter at an employee by employee level. You can't simply take the sum of all of the salaries and wages and average that out per week and compare that to per week in the first quarter. That's not going to work. You have to go employee by employee, and any employee that is reduced by more than 25% factors into this calculation on a dollar for dollar basis, reducing your overall maximum forgiveness amount. Subject to, here's where it gets complicated, who's in and who's out of this equation. Anybody that earned over $100,000 in 2019 is out of that equation. You do not have to calculate that comparison. But let's make it more interesting, not make it simple and let's just look at W-2s. No, what we actually have to do is we have to look at every employee in every pay period during 2019, annualize that, and if in any one of those it topped $100,000, they're out of the equation. So by example, you've got a $52,000 a year person to whom you gave a $10,000 bonus on June 30th for generally being a good person. Great. That means if you're a biweekly payer, every pay period in 2019, they got $2,000 gross, except for that June 30th one when they got $12,000 gross, which makes them a $144,000 annualized person. They're out of the equation. So it's a lot of detail to go through just to figure out who's in and who's out before you actually then do the calculations. So this is suggesting you're going to have to look at every employee, every pay period, essentially from January 1st of 2019 through the end of your covered period. It's a lot of data.
John, when you say they're out of the equation, are they out of the equation for that period, or are they out for the entire 8-week period?
They're out as it relates to this reduction factor, meaning they do not need to be counted. And if that $52,000 a year person, you cut them to $30,000 in 2020, no problem. You can cut them to $10,000. It's not going to factor against your forgiveness amount. Okay.
Thank you.
So that's the salary and wage reduction one, simple as it isn't. Then we get on to the second one, and that is the proportionate reduction in FTEs over the 8-week use period against one of two base periods that you get to select. And you naturally will select the more favorable one of those. So if, for example, you were at 40 employees in one base period and 50 in the other, you're going to want to use 40 as your denominator here and compare against that the number of, I misspoke. I use the word employees. It's FTEs, not employees. So what's the number of FTEs that you had during the base periods? Compare the lower of those two against your covered period. If there is a reduction of 5%, then your forgiveness amount comes down by 5%. If it's by 20%, forgiveness comes down by 20%. And this is applied, fortunately, after you do the salary and wage reduction one, which is a dollar reduction, not a percent reduction. So I'm hoping you're thoroughly confused by now. But in simple terms, let's say you had a $500,000 loan, you had to do a $100,000 salary and wage reduction, or not loan, but forgiveness amount. You did a $100,000 wage reduction. That brings your baseline now to $400,000, and you have to apply a 25% FTE reduction. That brings you down to $300,000. But if you had to do it the other way around, you'd actually end up with a lower forgiveness amount. So the percentage is going on a lower dollar value than if it was just the first part of the calculation. So that all adds up to something called your modified forgiveness total. Okay, your spent amount in the authorized uses less those two reduction factors gets you your modified forgiveness total. So that's one data point. Set that one aside. A second data point then is payroll costs if you spent less than 75% of your total on payroll. So if you're over 75%, this becomes a moot point. But if you are at 70 or 60% of your spend on payroll cost, you now have to take that payroll cost number, divide it by 0.75, and you're going to then have either that number or that number I just told you to set aside, the modified forgiveness total. The lower of those two becomes your net forgiveness amount. So that's the basics.
That's the basics. Okay, now I'm refilling my wine glass. But a question
I've moved on to crack cocaine by now.
is, and I think you're going to talk about this a little later, how you determine what an FTE, a full-time equivalent, is.
Yep, absolutely. We'll go through that.
Okay.
But here's in simple terms, it's 40 hours, which is good, but it's also bad. And I'll come back to that in a little bit. So there is a safe harbor on those salary reduction factors. And that you do not need to meet both of these to get one of the safe harbors. In other words, if you meet the salary reduction safe harbor, that takes the salary reduction one off the table. If you don't meet the FTE one, that one does not come off the table. So if you want them both removed, you can hit both safe harbors and they'll go away. Those safe harbors are this: basically, restore by June 30th either the number of employees you had at Feb 15 or the salaries that you had at Feb 15, and you won't have to deal with those two reductions. And those are very important things. Note, however, that there are some interesting dates on here. Let's say you did a layoff at May 1st. Okay, well, you're outside that 215 to 426 window. So what happens? Basically, you're off the hook as it relates to the FTE reduction, because you're looking at only that period of time when you had a layoff or a salary reduction. So there's some interesting things that will factor in, and I'm going to go through an example here in the next two slides that walks through this with numbers, and you can see the impact potentially of this safe harbor. But that's an important thing for you to know, and see the point at the bottom there. Note that it's not clear whether you can hire just for one day to qualify or whether you need to pre-hire, meaning, well, okay, I did a big layoff at March 15th and I don't have a reason to bring them back, but on June 29th, I'm going to bring them back and hold them until July 1st. Yeah, you can do that. It's kind of outside the probably moral specter of the CARES Act, but it does not seem to be specifically excluded. It simply says restored by June 30th without any guidance that says anything other than that date. So you do have that going for you.
And John, let me jump in here. When you talk about rehiring, whether it's June 30th or anything else to restore this, you do not have to rehire the same employee that you furloughed or terminated, correct?
Correct. It's a count in FTEs. So we're not, comparing noses to noses here. The other two other significant things that came out in the guidance that was released on Friday night is, one, this idea that both costs incurred and payments made during the covered period in all expense categories are includable as in the forgiveness amount calculation. Meaning, if I made a payment, let's play out an example. I got funded on April 26th. I pay semi-monthly. Great. That means April 30th, I made a payroll. I get to count that. I made the payment during the covered period. I did another payroll on May 15th and May 31st and June 15th. All of those are in my covered period. My covered period actually ends June 21st or 22nd or something like that. For argument's purposes, let's say June 22nd. So I also incurred payroll cost from June 15th to the end of my covered period of June 21st. I get to include that too. So if you look at it in that sense, you actually could get more than 8 weeks of payroll into this. If the calendar worked just so for you, you could get almost 12 weeks if you're a monthly payer. So in that example I just used, April 30th, I pay my April payroll. May 31st, I pay my May. So I've just covered 9 weeks right there. And I get 3 weeks of June in accrual before I pay that on June 30th. So at that point, I'm getting almost 12 weeks of pay potentially. Now that's only if you're a monthly payer and the calendar lands just right. But point being that you do get to include both the payments that you made during the period and any costs that you incurred but did not pay during the period. Okay. So another example would be my rent. In that example, I got funded April 26th. I paid my May 1st rent. I paid my June 1st rent. Do I get to prepay my July 1st rent? If I'm paying my rent in arrears, I get to include it. So if my May 1st, I was paying my April occupancy, then great. I can take 3 weeks of June occupancy as well, which I will be paying for on July 1st. Alternatively, if I'm paying in advance, then I paid my May rent on May 1st. I paid my June rent on June 1st, and I can get a few days of April rent that I incurred but did not pay as I prepaid it. So it's going to be very difficult from a documentation standpoint when you get into those accruals, which, makes accountants' heads blow up, but that's what they've put in. And so that helps people to maximize their spend usage of those loan proceeds. So that was one major clarification. And the second, nobody saw coming. And that is this notion of an alternative covered period for payroll costs. Now, it only applies if you're a weekly or biweekly payer. It doesn't apply if you're a semi-monthly or monthly payer. I don't know why, but that's what they did. So what this allows you to do is, let's say, again, on April 26th funding example, that's great, but my pay period actually starts May 1st. I was in the middle of one when I got funded. I can shift my covered period to make it starting at the beginning of the next pay period, May 1st, for the next 8 weeks, whether that's 4 or 8 pay periods. I can make that shift for purposes of this calculation to make it a little bit easier. I don't have to take 3 days of one and 2 days on the backside and all that kind of stuff. So that is at the borrower's option. Again, as with virtually everything I've said here, further SBA guidance is expected, and a bunch of this stuff may be laid waste here by the end of the day today. It's hard to say, but that's the rules as they are right now around the forgiveness map. So let me walk you through 2 examples so you can see kind of how this actually plays out. So the first is our good friends at ABC Company, who early on said, oh, we're going to have a problem here. And they laid off 20% of their staff. And in addition, for the remaining 80% of their staff, did a pay reduction. Okay, well, how does this play out? So they got $1 million loan amount because their average payroll in 2019 was about $400,000 a month. Times 2.5 gets me to $1 million. But in the course of this, because they laid off people and they cut salaries and a bunch of other things, they actually only ended up spending $600,000 of that $1 million that they were granted. And because they cut so far back, they only ended up spending about $450,000 on payroll, which met the 75% test. However, because they had reduced a number of employees by a significant amount, they ended up with a $300,000 reduction factor when they added all that up, which comes off the 600. And then because they'd laid off 20% of their staff and did not restore them, they have to multiply that remaining 300 by 80%. That leaves them with a modified forgiveness total of $240,000. 600 spent minus 300 wage reduction factor times 0.8 gets you to the $240,000. Okay. The next test, remember, set that aside. Now let's do this other test. Payroll cost divide by 0.75. So I have to take that 450,000 that was spent, divide by 0.75, and I get right back to $600,000 as a forgiveness amount. But remember, I take the smaller of the two. So in this case, my net forgiveness amount is $240,000. I still owe $760,000 to the bank. Okay. So even though I did all the right things from a 75% standpoint, I still have this significant impact of these reduction factors. And there's an awful lot of people who are walking into this who have not availed themselves of webinars and things like that, who are under the impression that this, whatever I spend, in this case, $600,000, just becomes a grant and I'm not going to owe anything back other than the 400 I didn't spend, which I'll just give it back to you. So that's not the case in this example. Okay?
In your example, John, the $300,000 wage reduction factor is really for firms that have reduced salaries below that 75%.
Correct. And
threshold.
it's not the, I mean, put it in simple terms, I took a $100,000 a year person and I cut them to 70. I don't have to take $30,000. I only have to take 5. It's the amount below the 75% threshold.
What if I took a $150,000 person and cut them to 75?
Not a problem. Cut away. Have a good time.
Because they're over 100,000.
You might upset that person, but you're not going to be penalized. They were, but you won't be. Okay. So that's ABC Company. And the nasty hit they took from those reduction factors. Let's flip to our other good friends across the street at XYZ Company, who laid off a third of their staff at January 15th, and at February 1st took the remaining 2/3 and cut their pay in half. Okay, what happens to these friends? They too spent $600,000, but because they took a bigger hack to their staff, ended up only spending $400,000 on payroll, which, as you can do the math, 400 over 600, 67%. They did not hit the 75% target. But because they did not do those wage cuts after February 15th, that's off the table. They don't have to deal with that. They cut everybody and then they kept them there. Also, because their layoff happened on January 15th, they don't have to factor in an FTE reduction quotient. So in this case, their modified forgiveness total is the amount spent, $600K, minus a 0 times 100% gets you to $600K. So and then we go to that second test, which is the payroll cost divided by 0.75. Remember, this comes into play when you don't hit that 75% target. In this case, at 400 over 600, they did not. So you have to take the 400,000 that they did spend on payroll cost, divide by 0.75, and that leaves you with $533,333. That, being the smaller of the two numbers, becomes their net forgiveness amount. So in that case, they'll end up owing $466,667 back to the bank on this 1% 2-year loan. So you got two very different examples here. One took a harder cut than the other, also didn't hit the 75% threshold, but because of the vagaries of the calendar and the way the laws are written, actually comes out way ahead on the deal. Okay, enough math for one day. Any of you that took out a loan over $2 million, I'm sure you are painfully aware of Treasury Secretary Mnuchin's sword rattling that we're going to audit every one of these, not only on the way you spent the money, but did you really need it in the first place? If you took over $2 million and you're on this call, that's probably because you decided you needed it and you kept the money because yesterday was your deadline to turn it in under safe harbor. So it's going to be really important that if you haven't already done so, document what the need was that you had at the time you made the application based on whatever you expected the business outlook to be at, say, April 5th or something like that. Have that in the files. If you do get audited, and there's no guarantee that you're going to, even though they've said that's what's going to happen. It's a lot of loans for them to go audit. You just want to be prepared and not have to try to do some retroactive math on that stuff. So get that done now, stick it in the files so that you're ready, but keep this in mind. There's a bunch of FAQs that the Treasury Department has put out, and the one that set everybody's heart aflutter was number 31, which said all borrowers must assess their economic need for a PPP loan, italics and underlined important here, under the standard established by the CARES Act and the regulations at the time of the loan application. Okay, so that is a significant thing to keep in mind. Dealing with lawyers here, I know that this is probably something that's going to end up getting litigated if they try to come back and say, well, subsequent to when you applied, we changed the rules and decided that we were going to put some need factor out there that was contradictory to FAQ number 17, which said you're basically good based on whatever you knew at the time that you applied. So that one will be a very interesting one, but it seems to get lost in most interpretations of this FAQ, this underlying part that it's at the time of the loan application, not 3 weeks later when we came out with this FAQ. So
John,
just keep that one in mind.
yeah, on that point, many firms have been asking questions about this issue, and the what's termed credit elsewhere. The PPP loan is an SBA loan, and all SBA loans before this had a qualification that you needed to exhaust your credit elsewhere, your lines of credit and your loans. And this legislation has specifically took out that need of needing to have credit elsewhere. And that's what happened when the loan originally came out. Now, they have not retracted that. They have just added commentary to it to say you need to justify the economic need. So it doesn't take away that credit elsewhere clause, but it certainly puts it in question. So I kind of go back up to your second bullet here with we are recommending that all firms document, we call it a statement of need or a certification of necessity, memo to the file, backed up by a forecast or whatever you have, to show not only the PPP funds, but the utilization of any lines of credit or any other types of additional liquidity that you might be using, not just during this 8-week period, but during the next 6 to 12 to 18 months. Correct, John?
Absolutely, and that's great illumination. This is going to live for a while, particularly on these larger ones. So take every precaution you can so that you don't end up on the wrong side of the ruling on this one. The good news is they softened the saber where they were threatening civil and criminal penalties. They're now saying, well, if we say you owe us the money back and you pay it back, we're going to call it good. So that helps things quite a bit. Okay, so hopefully that's clarified, Mud, and we can kind of focus on some things that we want to encourage you to do now. And as I said at the outset, one of the most important things is just build that forecast. Plan how you're going to spend the money, or you're going to spend what's left in the remaining period of time that you have available to you. What are you going to do? What's the best thing for your business? It may be maximize forgiveness. It may not be. That may not be the right strategy. So think through, what does that mean beyond the 8-week covered period, and what's your business going to look like? How long are the courts going to be severely shut down and things like that? So that's a probably most critical step here, so that you are doing the right things for your business. This whole point of this program was to keep businesses and law firms afloat, not to necessarily create as much forgiveness as we could. So we want to be sure that that happens, and that you don't just say, great, I made it through 2 months and now I'm hitting the wall. Second most important thing that we would urge you to do is to segregate funds into a separate account. This does not mean, though it's nice to have, a separate bank account, but at least at a minimum, a separate GL cash account. You want to be able to demonstrate a very clear audit trail here, that the expenses that I paid, that I'm including in my forgiveness amount, tied directly back to the PPP funds that I got. Ideally, it's one deposit and multiple withdrawals. But obviously there are some things like a lot of times the payroll company is already set up to draw from a different account. Go ahead and let them draw from that account and just replenish out of the PPP account. You should be fine. You just want to make sure there's a good, clear audit trail. What you don't want to do is just take the loan funds, drop it into your operating account, and have a commingled set of funds that you really can't document that I use $A for expense X. Okay, you want to be able to keep this as clear and unassailable as you possibly can. That's also going to help you make sure you know where you are in your spending and where you are in terms of your percentages and things like that, if you don't have it all commingled together. The other thing that several people have asked us about, hey, should we just change our payroll cycles? Pretty much recommending not to do that. There's a bunch of laws around that as well. You're going to have to give a bunch of notice and documentation to your employees, several of whom, no matter what you do, are going to think that you're doing something insidious to them. So just kind of recommend you stay with what you've posted as your standard payroll cycles. Okay, so that's kind of it around all of that. In summary form, plan ahead. Plan your path for liquidity for however long you think this is going to go, and recognize, if you haven't already, that this is a really technical and complicated thing. There's liabilities attached to it that weren't quite as obvious on the front end when it sort of looked like free money. So just be very careful. Take your time. Know this: there is not a rush to get your forgiveness application into your lender the day after your 8-week covered period ends. There's a couple of reasons for that. One, there's this June 30th safe harbor, and if you were funded prior to May 5th, your covered period ends prior to June 30th. If you have the ability to exercise that safe harbor at June 30th, you're going to want to do that. Two, one of the pieces of documentation that is being required to be submitted to your lender is, and it's a little bit vague in how it's written, but assume that it is your 941 Q2 payroll tax form. It's a little bit silly for a couple of reasons. One, you've got 8 weeks of pay that's encapsulated in the 13 weeks of the 941, but okay, it's at least a sanity check that there's not sort of massive fraud going on here. The other issue is most people aren't going to have a 941 to even submit to their lender until at the earliest, the middle of July. So there's two reasons to slow down on this. The third is you want to make sure you get this right. You want to make sure you get the maximum you're entitled to. And it's also entirely likely that they will continue to put guidance out well after your covered period ends. And virtually all guidance that they've been putting out ends up being in the borrower's favor. So you don't want to sit there and lock something in, and then it's a little like getting a mortgage. Gee, it's nice that I locked at 4% and then rates went to 3.5. Can I change? No, I was locked. Okay, well, that's a problem. So you don't want to end up in that kind of a situation. So 3 really good reasons in my mind to take your time after the covered period. Make sure you get this right, and get the maximum that you're entitled to. Okay, so we've compiled a list of frequently asked questions that hopefully we'll get into some details here. And we've got time as well on the backside for any other questions we haven't addressed or answers we've given that raise new questions. So we've kind of broken these into three categories. The first is kind of program level questions. Second is around use of funds. And the third is on forgiveness, math and what's in and what's out and those kinds of things. So the first question is, hey, my 8-week period won't allow me to make 4 regularly scheduled payrolls if I'm a biweekly payer and my 2 monthly rent payments. What do I do? I think that one was a more relevant question before last Friday that's now kind of been answered with the presence of the costs incurred and payments made one. So you should be fine on that one. If you need to prepay by a day or two, that's fine, because you also get to take credit for a payment made, even if it's not distributed to your employees the day that the payroll company got funded. That's fine as well. Okay, I got funded after May 6th. My 8 weeks are going to run out after June 30th. As my covered period suddenly end and I really only get 6 or 7 weeks? The answer is no. The June 30th is in there as it relates to the forgiveness calculation, but it is not the end of your covered period. So you should be just fine there. Don't fret. Third one, Dave, this is a good one for you. I'm going to let you handle
let me go
this.
ahead and give you a break there.
You're the tax guy, man. You
I'm
handle
the tax
this.
guy here. So are payments made with forgiven funds deductible? The answer is no. The forgiven funds are not taxable, and payments made with those forgiven funds are not deductible. That was clarified a couple weeks ago. That was in the very beginning kind of a nice unintended consequence when they came out with it. If you got $1 million loan and it was all forgiven, that was non-taxable, and at that point, all the payments made with that were deductible, which gave you another tax benefit. That was a couple of weeks later taken away, and now it just nets to zero. The forgiveness is not taxable. The payments made with that are not deductible.
That being said, the Senate committee that crafted the CARES Act has come out and said, yeah, thanks, IRS. That wasn't exactly what we intended, but recognize that the IRS is not necessarily a lawmaking, they're a law enforcing body. So since the CARES Act did not specifically say that, what is that section, was it 265, Dave, of the revenue code, whatever it is, the one that says that, I'm not the tax guy, the one that says that you can't deduct tax-free expenses against tax-free income,
right?
That one. So the IRS is in the position of having to enforce it because you didn't say that we shouldn't. So the Senate committee is talking about and has made a lot of noise about getting this legislation adjusted so that this does become deductible. But as of today, May 19th, it is not deductible, so it ends up being a neutral event. What happens if I don't use all the money? Don't go out and buy a Learjet. You can continue to use the money, at least 75% of it for payroll, as we understand, based on the IFRN that came out. What's a little bit unspoken at the moment is the remaining 25%. So this becomes a standard 7A loan, and 7A loans have broader uses than PPP did. So there may be a window for you to use that remaining 25% that isn't used on payroll for other uses beyond the 3 or 4 that are included in the forgiveness calculation. But again, there's been absolutely no guidance whatsoever as to how they're going to enforce any of that. But net is that this rolls over into a 1% 2-year loan. The HEROES Act is suggesting it may go to a 5-year loan, but the HEROES Act has so much to it that is probably weeks, if not months, away from ever actually becoming law, if ever. And the last question around the program side is, do I have to rehire everyone, and can I fire them all again on July 1st? No, you don't have to rehire everyone. Just understand that it has an implication in your reduction factor on your forgiveness amount. And can you fire them all again on July 1st? Yes, you can, if that's something that in your heart of hearts you want to do. So let's spill over into the use of funds sides of things. These are all questions we've been asked quite a bit. Can I use this money to pay bonuses? And the answer is yes, with a little bit of a caveat around that. We're encouraging people, if you normally pay bonuses in the middle of the second quarter, fine, go ahead and pay them. You've got a standard business practice that you normally do. It shouldn't be a problem. If you want to give people a little bit of a, we'll call it trauma bonus for all that they've had to do for you over the last couple of months, that should be fine. What they don't want to see is, hey, I took this $50,000 a year person and gave them a $49,999 bonus to keep them under that $100,000 mark. Yeah, don't want to do that. Again, recall that $100,000 mark is on an annualized basis. So within the covered period, the max is actually $15,385 per person. So if you had a $52,000 a year person in 8 weeks, they would have made $8,000. Probably don't want to see a $7,300 bonus going to them on top of that, unless, of course, it was in the normal course of business. This question has come up with other attorneys and law firms. Can I use PPP funds to make 2019 profit sharing contributions? Dave, how would you handle that?
I would say probably not. You would have to, and like your input on this, John, the prorate and make payments, or to accrue and make payments later. But there are a number of questions on, I haven't made my 2019 profit sharing payment yet, which would be for the whole year. And I'm fairly certain that if you paid it during your 8-week period, that is not going to fly. But
Correct.
do you prorate it for your employees, your profit sharing, and if people have a defined benefit plan?
Yeah, it's more a current period thing. 2019 profit sharing contribution was essentially a liability you walked into this whole COVID mess with. So that's something that I think they would definitely exclude if they were to check. Most lenders are going to exclude it from the ones that I've talked to, and I talk to several every day, and we've had this conversation. So I would not recommend you include that. That being said, the extent to which you make contributions to a 2020 profit sharing or incur an obligation against that, which is a little bit dicey on
Right.
profit sharing being an obligation. It's more of an election. That's a different story, but the idea is not to be able to pick up all those old obligations.
John, under the new guidance where they talk about incurred, allowing something that is incurred, if you have a 401k plans that have employer contributions, safe harbor matching, might be easier. They might be paid on a quarterly basis. Defined benefit plans are usually paid on an annual basis. So if it is incurred and not paid currently, how would you handle that?
Great question. The way the regulations are written in the application itself, it talks about incurred and paid in the next time in which you would be normally paying it. I think they're thinking of it more in the context of a utility statement that, great, my period ended June 22nd and my bill comes in on July 2nd. Great, I paid it July 2nd, but I incurred it. That, I don't know how exactly you split an electric bill, but that would, I think, is what they're thinking. But in the case of something like a quarterly payment, to me, my interpretation would be that's the next time I'm supposed to pay it. So I incurred 8/13 of that expense. I paid it whenever the payment was due. That should be fine. It's a little dicier on an annual one. I'm not
Yeah.
exactly sure, Dave, how I'd handle that one. We may need to get some guidance on that.
Yeah, and I think we're waiting for more guidance on that. Without the guidance, the defined benefit plans for those who have them are large. And there's a question of, is that an amount on top of compensation? So, most of the defined benefit plans kind of strategically help the owners that are pretty much all make over $100,000, so they're capped at $100,000. But on top of that, they have these pretty rich defined benefit plans. So there's a lot of money, and that adds on top of the $100,000 cap, correct?
Correct.
And the payment of that, I might suggest, without any further guidance, that if you have these defined benefit plans, that you actually make a contribution, which you can, during the year. So sometime after your 8-week period, you might calculate an estimated amount that you would have accrued, and you make that payment into your defined benefit plan. Again, they would just be estimates, but without further clarity and guidance, that's what I would probably recommend.
Okay, moving on. Number 8, owners are paid by K-1 and not a W-2. Can we include those payments as payroll costs? And the answer to that is yes, up to $15,385.
Right. And that was just clarified, I don't know, a week or two ago, that K1 doesn't just have to be W-2s. It can be your K1 partners that are included. If you have people you call of counsel and you pay them on 1099s, they cannot be included.
Correct.
So the only people you can include are W-2 employees or K1 partners.
And those K-1 partners need to be in the form, that compensation needs to be in the form of guaranteed comp and not distributions. Correct, Dave?
Correct.
Okay. Important little thing there. Don't call it a distribution. Okay. Well, on the subject of owners, can their health premiums be used for PPP funds? And the answer to that is no. Only employee health premiums that the employer pays. Anything you want to add to that, Dave? Or is that
Nope,
succinct?
that's a real straightforward one.
All right, good.
So
Got that one right.
So anybody that gets a K1, you've got a $100,000 cap. You cannot add health benefits, health premiums on top of that.
Right. Number 10, I touched on this earlier. What expenses are considered utilities? Water, gas, electric, telephone, internet access, and whatever transportation means. You get bundled internet, telephone, and television. Unbundle the TV. It's not included. Okay, an awful lot of people are under a triple net lease. Can I just take the full amount that I pay the landlord, which covers, in addition to the rent, property taxes, insurance, common area maintenance? The answer is no. Separate out the cost that you're paying for your space only.
John.
Dave.
Since your team is going to be processing a lot of these forgiveness applications on behalf of banks,
Yep.
Are you or banks going to be looking at leases in this detail to parse out this, what is your rent and insurance and taxes?
I can't speak for all banks, but I can speak for the banks that we're going to be doing this for, and the answer is yes.
There you go.
There you go.
Third glass of wine.
Onto my second spoon. Okay. If we deferred our March rent because we could, and now I got these loans and I want to make up for it and pay it during the covered period, do I get to include that as rent? And I think the answer on that one's going to be no. And the reason why I say I think is it depends a little bit. The objective here is basically 2 months worth of rent. So if I got caught up and paid my March and my April, then I can include March and April. If I paid March, April, May, and June, then I can include either March and April or May and June or April and May, but basically 2 months worth. So the fact that you caught up to it and this by the same logic that we're not going to allow you to also prepay July, August, and September, that it's basically keep it to 2 months. And the next one on use of funds is we've got a lot of temps. We don't actually pay them. We pay their agency who pays them. Do we get to include those costs as our payroll costs? And the answer to that is no. That's an accounts payable. You do not get to include any temps that you do not pay directly. And last around the use of funds is, am I restricted in my use of leftover funds? I pretty much hit this one already. According to the IFRN, yes, you are, as it relates to 75% being for payroll. But again, we don't know exactly how that's going to, how to get that gets confirmed or certified or anything at this point, nor has any banks been given any insight on that, other than to say, we hope we don't have to confirm any of that stuff. They told me that. Okay.
Let me go back up to another question in, there you go, use of funds.
Yep.
Under the health insurance, where we said health insurance premiums are not eligible for K1s. If you happen to be a corporation and all your people are W-2s and your shareholders, then your health premiums are includable, correct?
Good clarification, yes.
Okay.
Anything else you want to add there, Dave?
Oh, I think I'm good for that.
Well, okay. You just add in whenever you'd like. All right, let's hit the last batch, which is forgiveness questions. Then we'll open up to, I've seen there's about a dozen or so in the chat already.
Yeah.
So does forgiveness use the same $100,000 payroll cost per person limit as the loan application did? Yes is the answer to that, $15,385 for the covered period. 16, can I include the payroll cost in the forgiveness calculation for people I did not include in the loan application? Like before I knew I could do equity partners, I went in and put in the loan and got funded. Then I found out I could have put $100,000 per partner in. The answer to this is yes. If it was allowable and you didn't ask for it, doesn't mean it wasn't an allowable use. So yes, you can include them in the forgiveness. And I believe it was last week, it was also announced that you can go back for a second tranche and include your equity partners if you didn't the first go around.
Which is up to your lender. And there are some lenders that are just taking the position of saying, no, thank you. We will not process those additional requests. So it's very dependent on your lender. So if you did not include your equity partners, talk to your lender on that. But this is a huge one, because if you did not get those funds for equity partners, you can still use the amounts paid up to the limitation of $15,385 for forgiveness, which really helps those firms get to total forgiveness that I've seen.
Number 17, will severance or PTO payouts count in compensation for forgiveness? The answer is yes, if the person has left. No, in the case of, well, presumably if they didn't leave, you're not giving severance. But some people have said, well, I've got this big PTO liability. Can I just pay all my staff off, clear the liability off the books and count that as forgiveness? And the answer there is no. That's kind of counter to the intent, which is what we fall back on time and again. What's the intent behind the law? And it wasn't for windfalls. Can I repay some of my loan now to lower my denominator and better my chances? And the answer there is no. Your denominator is a function of what you spend, not what you took out. So that's not something that's going to change your overall forgiveness calculation. This has come up a couple of times. HSA contributions, did those count as health insurance benefits? And our answer on that one is yes, go ahead and include those in your contributions to payroll costs. Dave, you touched on this a minute ago. Is there any forgiveness difference between employer payments for contribution plans versus defined benefit plans?
The answer is no to that.
Good answer, Dave.
Thank you.
You can have my job. Number 21. I'm guessing this is probably not a relevant question for this audience, but it has come.
Probably not.
So the answer is no. So we'll just move on. Number 22. If we cut back on overtime for hourlies or cut bonuses for salaried staff, does that count as a wage reduction? Okay. The answer here is no. It's actually irrelevant to the wage reduction calculation. The wage reduction calculation is a function of what was the average that was paid, whether that was in overtime or non-overtime, whether that was in regular comp or bonus comp. What was the average paid in the 8 weeks versus the average paid in the first quarter? That's your wage reduction, regardless of the form that that compensation took. Okay. But on the subject of overtime, I'm going to actually go back for a second. On the subject of overtime, Dave asked a while ago, and I said I would come back to it, is the FTE's calculation is 40 hours. What was originally the thought is, in order to figure out FTEs, you basically take your payroll hours worked off your payroll report in total, divide by 40, and there's your FTEs. Doesn't actually work that way. Just again, to make things complicated. There's several things they did just to make things complicated, and this is one of them. So you have the option on FTE counts to either count as 1.0 any full-time employee or 0.5 any part-time employee. Well, if you've got a lot of people who show up for a day a week and not many others that are part-time, then great, you're going to want to elect that 0.5 option. By contrast, if you got a lot of 30 or 32 hour a week people, yeah, you're probably going to want to actually do the math on it. Here's where it gets complicated, maybe less so in a largely salary-based law firm, but in a number of your clients that have a lot of hourly people, anything over 40 comes out of the equation. So somebody that worked 50 hours in a week does not count as 1.25. They count as 1.0. So you can't just take the total hours worked off the payroll report. You actually have to go person by person by person.
But they did simplify it. There's one simplification measure, didn't they? For people under 40 hours, you can put them at a 0.5.
Yes, you can.
For part-time people.
But you got to take out all those other hours. So it's not just a straight math equation. You've really got to look at it, as with so many things in this, at a person by person level. Okay, self-employed individuals, do they get to have non-payroll forgiven? The guidance that has been given out so far is essentially your forgiveness totals 8/52 of your 2019 net income on Schedule C, for any of you for whom that is relevant. I knew I had an FTE question in here. There it is. I've already covered that. I was thinking that was the one after 22, so I had my order wrong there, but I think we've covered that one. If an employee resigns during the covered period, does that affect the FTE reduction calculation? The answer is yes, it actually helps you. If they resign and are not replaced, you do not need to include them in the denominator, okay? So that is a pleasant surprise that came out in this last go-round last Friday. And I also touched on this a little while ago. How long after my covered period do I have to file my forgiveness application with the bank? Remember that I counseled to go slow, make sure all the dust is settled and you get this right the first time. There actually is no clock on the borrower. When your covered period ends, there's nothing that says you have X amount of time to get your forgiveness application into the lender. There is a clock on the part of the lender, and there is a clock on the part of the SBA, but not on the borrower. So once your application lands in the lender's lap, they have 60 days in which to render a decision, communicate that to you, and convey that to the SBA. Once it's conveyed to the SBA has 90 days to accept that and reimburse the bank for the amount that will bring your principal on your loan down to your forgiveness amount or your leftover amount. That suggests that a bank may not actually be cleared of this until the end of the year if they took the full 60 days after, say, a late July application lands in their lap, and the SBA took the full 90 days. It could take a while for all this to actually roll back into your principal amount. So just be aware of that. I don't think it's going to have a major impact on anybody other than the banks, but you do not have a clock ticking on you to get that application in.
John, talking about timeframes, what's your best guess after you file the application and then the SBA gives their approval, the bank gives theirs, the SBA gives theirs? What about the audit risk that we're all so keenly aware of from the SBA? What do you think on that?
I think the likelihood, if you're under $2 million, is pretty low to begin with. You're still subject to review on your forgiveness spend, just not on your safe harbor was on the need side, not the spend side. On the larger than $2 million loans, your review is on both sides, the need and the spend. The probability is quite a bit higher there. That being said, I didn't look at the actual statistics that came out today, but I believe the number of $2 million plus loans numbers well into the millions, I believe. No, I'm sorry. There's about 5 million total loans. So the $2 million plus are in the 100,000s. That's a lot of audits, and it's not like they've got tons of staff to be able to do this. Now, I do recognize that round 2 of the CARES Act gave the SBA another $2.1 billion in salary coverage through the end of 2021, which buys a lot of auditors. But I think that the below 2 million risk is pretty low, particularly given that there's going to be a review on all of these things already by the bank in order to render a forgiveness decision. So,
and is there any statute that they have to audit here?
You're asking a non-lawyer in front of a group of lawyers, Dave. I don't know what the statute limitations is on that one. I'm sorry.
Okay, we're going to cross that one off. I retract that question.
So, Dave, I know there's a bunch of questions that have come in on the chat. Have you kind of gone through those, or can you post some of them?
Can I just throw them out, pebble you with them?
Yep.
Okay. Is monthly parking for the building that we rent an allowable and forgivable cost?
Great question. I'm going to say yes. I'm going to include that in the context of either rent or transportation, but more likely rent. That is for the purpose of your employees to be able to work there, just the same as having space for them is. So I'm going to say yes. Okay. But there's no guidance that's been given one way or the other on that one.
Okay.
And as with everything so far, remember, it's all subject to change. How's that for a caveat?
That's your fallback.
You bet. Disclaim away.
There are a few questions on this, clarification of the significance of the period February 15th to April 26th. Mm-hmm. Can you clarify that?
That's as it relates to those the safe harbor for the 2 reduction factors. So that was technically written from February 15th, excuse me, until 30 days after the date the act is signed into law, which was March 27th. So basically it's Feb 15 to April 26th. If you did a reduction during that period, you are subject to the FTE calculation. If you did a salary reduction during that calculation or during that period, you are also subject to the reduction calculation and the safe harbor. So it really relates more, I probably misspoke there a little bit. It relates more to the safe harbor side of things than to the actual reduction calculations, because the reduction calculations don't take into account April 26th. But one thing I will point out, the number of dates that you have to try to keep track of in the course of all of this data is nothing short of staggering. So you've got to look, as I said earlier, at every pay period for every employee in 2019, every pay period for every employee in 2020. What's your FTE count on average in the first quarter? What's your FTE count on average during the covered period? What's your salary on average per person in those two periods? In addition, for some inexplicable reason, the application asks for you to list the number of employees without defining what employee means, presumably headcount, that you had at the time of your loan application and that you have at the time of your forgiveness application. Apropos of absolutely nothing, because those two dates and two figures are not used in any calculation. But they ask for them, and for some completely unknown reason, they want to have the last four digits of the Social Security number for every employee. No earthly clue why they need that. But regardless, there's a lot of data that they want here.
Lots of data
Sorry, I just like to riff on this.
Is the key to that one, boy. I'm reading some of these questions and trying to see which ones just repeat here. I think we've answered a number of them. I think we've already answered this, but there's a number of these questions. Do employer health costs for the employees count as payroll?
Absolutely.
What else can be considered payroll? I think health, dental, vision, not life insurance, profit sharing, 401k, defined benefit costs for employees, all that good stuff.
Yep.
On that taxation question of loan forgiveness, does California comply? California complies on the non-taxability of the forgiveness. I am not sure where it stands on the deductibility. California, I would imagine, will comply with whatever the federal does. That's my view of it. I know they comply with.
That'd be a first.
You're right, yeah. That they definitely comply with the forgiveness not being taxable income. Talked about the retirement contributions, or a number of questions here. The retirement contributions that were on behalf of 2019 should not be included in this 8-week period. Correct. It would only be your contributions, your 401k, your profit sharing, your defined benefit plan, cash balance plan, that are for 2020 that are part of this. Interesting one. Are the costs of a payroll company like ADP payroll costs?
No, they are not. That is an accounts payable, kind of like the question around the temp agency. That is a cost of doing payroll, but is not a payroll cost for the benefit of your employees.
Okay. Here's a good one. John.
Yes.
Will you be sending out the answers to the FAQs that you?
No, you have to listen time and time and time again.
And you have to write them down.
I think there's probably, I know that if this is being recorded, and if you can post it up on YouTube, it automatically transcribes, which will give all those answers. Yeah. I don't know the exact technical way to do that, but I know our marketing people do if the Bar Association needs some help with that.
And if not, you have some videos posted, I think 3 now, webinar videos posted that, having been a part of it and listened to the others, all those answers are on those videos also.
And those are transcribed. So yeah, you can get to those on our website.
Similar questions. Anytime, there are questions about paying independent contractors rather than employees.
Nope.
Answers no. Here's one. Are payments for short-term disability, long-term disability, and accidental death and dismemberment that are paid for by the employer part of the allowable payroll costs?
The payment for the disability or the payment for the disability insurance?
Disability insurance.
That would be a no. Where our view of this is that insurance payments are, other than health insurance, are not considered a qualified expense for forgiveness purposes.
Okay.
There was an interesting question that came up in another webinar that I did around self-employed. It was a hospital that, or not self-employed, self-insured, a hospital that says, well, we just basically self-insure all of our employees. So we don't make insurance payments, we pay claims, which is a really interesting take on things. I don't know if anybody is in that boat in this group. I don't have a definitive answer on that, unfortunately. I think that's one we're going to have to go get some guidance on. My assumption would be if in the course of applying for the loan, you calculated payroll costs and included the cost of claims, then it should stand to reason that it would apply on the backside as well. But I thought it was a very interesting question that had not come up in any guidance that I'd seen anywhere.
Interesting question. I mean, people have such, personal questions. Here's a question about, can we increase salaries and or hours for employees and include the increase in the forgiveness calculation? That is, include a higher amount of payroll for forgiveness than the amounts which were used to calculate the loan amount.
Well, it doesn't have to match what was in the loan amount. The loan amount was the average of 2019. Presumably, an awful lot of people got a raise at the beginning of 2020. So that's already going to make you different from the average in 2019 at an employee by employee level. So it's not so much that. I think what they're going to not want to see is, well, I just cranked everybody up to 15,385 for 8 weeks because I could. That again is back to that spirit and intent of the law, kind of not intending to legislate in a windfall for people. It's basically, what's the purpose of this? It's to help businesses and law firms stay afloat so that they can get to the other side and still have a chance of survival come Q3.
Right. Can you use the funds retroactively to pay past payroll cuts?
I'm not sure quite what retroactively means in this case. In the example that I gave earlier of, hey, I got funded right at the end of my semi-monthly period, and I 2 days later paid a payroll. Yeah, I essentially am doing a retroactive pre-funding, pre-covered period payroll there. That's okay according to the rules as written right now. Again, subject to change.
Okay, here's one. I may stump you, and it's not a legal question.
Bring it on.
A self-employed individual.
Nope. Sorry.
Schedule C individual receives PPP funding.
Yep.
That person has also applied and is receiving unemployment insurance.
Okay.
Do they have to return one or the other?
Well, it does seem to be double dipping because if I've got a PPP loan, the intent of that is to, if I'm self-employed, pay myself.
Yeah.
And so at that point, it's double dipping. I would say, yeah, choose one or the other. And I think I know what the answer would be.
Here's a good one. Can workers' comp payments be included in the forgiven amount?
Workers' comp insurance is not included in forgivable spend.
Okay. Can payroll admin fees, I take that be like ADP, be categorized as utilities? And can you please define utilities one more time?
Answer to part A is no. It's just a standard accounts payable. Answer to part B is water, gas, electric, internet access, telephone, and transportation, which includes gasoline, fuel for company vehicles or company-owned vehicles, and presumably, to the earlier question, parking rent, which might be a utility as a transportation cost or might be a rent as a rent cost, but should be includable.
Okay.
Did we exhaust them?
I'm just reading through them one last time here.
This wouldn't be the first time I've exhausted an audience.
Oh, yeah, that is true. Oh, here's a good question.
Okay.
John, where did you get such a great radio announcer voice?
That did not get.
Come on, it's right here in black and white.
No, it did not. Jeez, David. Just stop. Just stop.
Okay. I think we have gone through them all.
All right.
One more.
Oh.
Can mileage reimbursement?
Does that count? I have not seen anything that says that would count as transportation cost. It may, because there's just been.
What about here? It clarifies it more. Can mileage reimbursement for a delivery driver be part of payroll cost?
Be part of payroll cost and not utility cost?
Yeah.
I think this would be my interpretation, and I have not seen any specific guidance on this, but my interpretation would be if that is a part of their compensation typically anyway, and presumably that was included in your analysis when you applied for the loan, then I would say, yeah, go ahead. If it's a standard thing. If I just suddenly decided to start doing it, that's a different story.
Okay. One more question snuck in here in the tail end.
All right.
My PPP loan funded on 5/7.
Okay.
Can I apply the funds to my payroll paid on 5/1?
The answer to that would be no. Your clock doesn't start ticking until you actually get the money, and you can't go on a look back.
Right.
Okay. So those of you that have stayed with us this far, God love you. We certainly appreciate it and admire your tenacity to stick through all of this fun stuff. I know it's awfully confusing. I want to let you know, get my little commercial in here. We can help you if you would like. Armanino is the 23rd or so largest accounting firm in the country, and we have a whole team of people that are very much as in tune with all of this stuff as I am, because we've trained them all up. So we can help you in one of two ways. During the covered period, we can help you to plan your use of funds and get some estimating modeling done. On the backside, once you've finished your covered period, we can also support you in preparing your application. We've got a complete forgiveness calculator all put together that's got all these right rules and all the right logic in it. All you have to do is send us your documentation. We'll do the data entry. You don't even have to do that. We'll just take the data that is required off of the documentation that we instruct you to send in, and you can basically sit back and wash your hands of it from there, other than you will need to sign and certify your application itself. But we'll walk through that whole process with you. If you're interested in details on either of those, they're all up on our website, which is at learn.armaninollp.com/SBA. And if you're interested in anything to do with COVID-19 things, we have close to 200 articles from across the firm that we have put together around these 5 categories. Not only the government aid stuff, but also around cash management, around back to work things. It's a real big thing right now. What are our policies around that? How do we decide how we're going to handle certain situations? What's within the laws? What's outside the laws? All of that stuff. So we've done a whole bunch of work around pulling people back in off of furlough or off of work from home that you may want to read with some interest, as well as a lot of things in managing communications and things specific to the legal industry. So all of this is available on our website at armaninollp.com. It's right there. As soon as you hit the site. You kind of can't miss it. It's the first thing you see, and just click the link and you're right into the Resource Center. Tons of great information in there that goes into all kinds of arcane detail. So have a good time with that. Thank you very much for joining us. Dave, thank you very much for being a part of this and helping me through this and
John,
fielding all
thank
the
you very
questions.
much for all your wisdom and time and your team. That was great. If anybody on this call has any quick questions, do not call John. He will be yodeling in the background. Feel free to call me. I will not be yodeling. Again, thanks for everybody joining. And John, thanks for all your tremendous information here.
And thanks to the great team at the Beverly Hills Bar for putting this together. Really appreciate the opportunity. Thank you very much, everybody.
Bye now.